Hello, Jim here from the Easy Investing Income YouTube channel. Today I want to share with you how to sell vertical put credit spreads. I'm going to go into a bit of detail and try not to make it too difficult. And then also at the end of the video, I had a trade earlier in the week where I made some really good bonus premium with Schwab. So stay tuned. I think you're going to really enjoy what I have for you today. So what is a vertical put credit spread? The easiest way for me to explain it is it's actually two contracts. You sell what I call an inner contract closer to the money, which you earn some premium, and then at the same time you buy a contract that's farther outside the money where you actually pay for that, and the combination of the two you end up with a credit. And the expiration is on the same day. So that's where it gets its name, the vertical put credit spread. So I'm actually going to jump into an example using a spreadsheet that I set up, and I'll do that here in a minute. But I do wanted to mention a few other things. Now, the important part of working with a vertical put credit spread is how you find the specific strike when you're selling the option. So again, just like if you're doing a cash secured put, you want to use value companies. You want to use the delta that you prefer. I prefer the 20 delta. You may prefer less risk like a 15 delta or a 10 delta, or more risk like a 25 delta. And then I also tried to look at trying to get the stock at like a 10% discount on what it's currently selling at. So if it's a $45 stock, then I'll try to get it for around $40. I feel like if you can get 10%, even if it's for 2-3 months out, you're doing really well. Next, I also look for outer arms that are very inexpensive. I found that in the market recently, a lot of people are buying put contracts, and it's causing a lot of the pricing for the puts to get more expensive. So I've had a tough time finding inexpensive puts that I can purchase at a healthy spread, meaning I like to do like a 10 or 5 spread with a lot of my vertical put credit spreads, meaning the difference between the two strikes is $10. So the inner may be a 40 strike, and then the outer may be a 30 strike. And I've had problems finding something that's inexpensive. If the outer strike for 30 is really expensive, then it doesn't really make sense to do the vertical put credit spread. In those cases, a lot of times I've done a cash secured put. And then the outer contract really protects you from a major market drop. So if you buy a put contract, say $30, you can put that to someone at $30. So you're kind of protected. If it goes below that $30 and you're able to put it to someone at 30, you don't have as much downside risk. Whereas a cash secured put, you've got complete downward risk, meaning if the stock went down 50%, you would take a substantial loss. Also, it requires less margin using a vertical put credit spread. The fact that you purchase that put, you don't need to use as much cash or margin, and I'll share that in the example. And as always, when you're dealing with these or cash secured puts, you really need to manage the contracts. You need to understand what you're getting into and what your options are for dealing with that. And we'll also talk about that in this spreadsheet. It'll make it a little bit easier to understand. Before we jump into that, I do want to mention, please hit that like button and subscribe. And as always, I do have a Patreon memberships. I actually have 2 memberships where the first membership includes all my different spreadsheets, includes all my trades. I literally will post them out to Patreon soon after I actually make the trade. Literally seconds after I make each trade. And I provide pretty much all my spreadsheets. Anything you see in these videos, I provide to my Patreons. And then that's for the $10 a month, and it's called my Investors Club. I have a Traders Club where if you need more hand holding, I do have a weekly meeting. I do have Discord, and I'm actually looking to provide one-on-one consulting, maybe 15 minutes or something along those lines each month. So if people want to talk to me directly, I'll provide, access to me where we can discuss your trades, and, maybe I can help you decide if it's a good trade or not. So that being said, let's go ahead and jump into the spreadsheet. So here's a spreadsheet. Hopefully this will explain it a little bit better with what a vertical put credit spread is. So this is kind of a make-believe stock, and I set up this graph, and you can see it's got three lines. Now the red line is the outer put that I purchased. It's $35, and then the gray line is the inner put that I sold to make it a credit spread, where I actually made enough premium. Here you can actually see when I made the trades, I made $97. And again, this is I just kind of made this up. This isn't an actual trade. At the end of the video, you'll see the actual trade, and I'll talk a little bit more about this. But in this sense, I made $97, and you can see with this red line, it protects you below this 35. I'm pretty much protected. If I end up having the shares assigned before the expiration, then I can always, if it goes down here, say in the 30s, I can always put it to someone at 35, minimizing my risk. Now, because of that, the margin requirements and the cash that I need is a lot less. So here at the top, I'm sharing what the margin requirements are. So for a cash secured put, it would be nearly $3,900, and that's just literally taking the $40 inner contract that I set up, which is you take 40 times 100, that's 4,000, and then you subtract what you made premium. So I would need $3,903 for cash or margin in my account to be able to cover this trade. Now, if I did a vertical put credit spread, you can see the huge difference. So I would only require $403, and how that's calculated is the difference between the inner and outer arms. So the $40 versus 35, and then you subtract those two and multiply by 100, which gives you 500 minus the premium you took in. So I would only need $403 of cash or margin to be able to make that trade. So it also helps in that way. You could actually do more trades and potentially take more risk. Not really more risk, but say you wanted to do 4 contracts, you could potentially do a less risky delta and do 4 contracts, and you would still need less than what you need here. You would need more like $1,600. So, and then I wanted to show that, so you can see what happened with the stock price. So at this point, it could expire back in March, and come right before 420, which is 2 weeks, a little less than 2 weeks before expiration, it actually went into the money. And so at this point, when it went into the money on April 20th, 22, and this was due to the price in the money, the market had a significant decrease or correction of 30%. And at that point, I had these 3 options I could do. I could do nothing and be assigned. And, again, if you're picked a stock that you want to own, then that's perfectly okay. It may feel bad because you're getting it for more than what the current price is, but when you first made this trade, it's probably a lot less than what you could have gotten it at that time. So it's still a valid option. The other one is you could roll it out for more premium. So here you can see this is kind of make-believe on what it would cost to close it. So it cost me $79. So as long as I made, and the way I do it is I like to earn at least $100. So if I could make $179 rolling it into the future and hopefully lower the strike price, then I would. So that's what I've done with most of my trades. I've been able to roll them. Now the market's been going down for the last 2 months, so it may be a little bit harder to roll come in March. So we'll see. And as always, I share all my trades after the fact, so you'll probably see sometime in April what happened in March. And then you could close it and you could take the loss. So if I closed it and I took a $79 loss, I still made $18. If you take into consideration the premium I made on the front end, I still made $18. So that just shows you how you would manage it. And again, you never wait to expiration day. You try to do it at least a week if you can, before expiration. And the same thing with ex-dividend date. Keep track of ex-dividend dates. Those are the only things that have really hit me hard with assignments, is I didn't keep track of ex-dividend dates early on, and I had quite a few trades actually get assigned, or positions get assigned. So hopefully this makes a little bit more sense. This red line really does add a lot of protection and does allow you to do a little bit more trading. But like I said before, the core principles of looking at delta, looking at risk, making sure you're looking at value companies makes a big difference in being successful, not just with cash secured puts and covered calls, but also with these vertical credit spreads. So let's jump into the next part of this video, and it's an actual trade. And again, it was one of those that I made some really good premium, and actually bonus premium. When I was looking to make the trade, it looked like I wasn't going to make as much as I did. So I encourage you to watch this next part. It is a trade done in Schwab, so if you've never worked with Schwab, you can see what it's like compared to whatever platform you're working on. So let's go ahead and jump into that next part of the video. Thanks for joining me. Hello. I've gone ahead and I've opened up Schwab, and I've actually got two pages open. One, I've got the summary of Academy Sports ASO. This is a company that I'm looking at currently to sell options on. It's one I really like. They've got really good earnings. They don't pay a dividend. That's a negative. I typically don't go for companies that don't pay dividends, but in their case, they've had such good earnings. And you can see here that Schwab actually gives them an A rating. And they're very optionable, and they're very inexpensive. They're down today. They're around $32. You can see that they're way off their high of 51, which is really surprising to me. If you look at their earnings, it's kind of pretty amazing. So they've beat in most of the recent quarters. Now, if we switch this to annual, you can really see it's pretty significant over the last what they're expecting for 2022 and 2021. And you can actually see this with the statements too. This is another way to look at the earnings. But they've done consistently better. If you look at operating income, it's been going up. It's this line here. So they're a good company. It's a company I use all the time. I like to shop there. I've just recently bought a bunch of t-shirts and sweatpants and tennis clothes, and they seem to be very reasonable, less expensive than Dick's, and there's one right near me, so I end up shopping there a lot. And that's one thing I like to do. I like to invest in companies that I actually shop at. So, and if we come over here to options, you'll see, let's go into the but here we can just look at this page. You can see the bid and ask. You can see the volume of contracts. So it's very optionable. So what I'm looking at is right now it started the day at 33. It's down about 50 cents. So you can see here it's at 32.55. So I'm hoping to get it right around 30, which is a little bit of a higher delta than I typically have gotten. One thing I want to change with doing the wheel is take a little bit more risk. I'd be happy to own Academy Sports at 30, plus I can get some pretty good premium if I look at 30, which I think is like a 28 delta versus a 20 delta. So if we come down and we look here, and this is 4 days, so we don't want to do anything that short. Let's look at 18 days. And you can see some pretty good premium at 30, 85 cents to 99 cents, and a fair number of contracts, so it's most likely would go into effect. Let's actually go and let's grab all the strikes. So one thing I like to do, so I'm thinking 30. Now it looks like there's an 18 at 20, meaning there's 18 cents that I could potentially, so I can open up a vertical put credit spread at 30 and 20, or I could just do a cash secured put at 30. So this would be the outer arm at 20, and I would pay probably close to $18 for that. And then I would receive 85 cents, between 85 and 99. So this is a trade I really want to make, and I'm hoping to get it as vertical credit spread. So let's actually go in and look at the trade. So you can see here I've got 44,000 that I can trade with. So I've got a fair amount of cash to trade with. And you can see here, you can see the bid and the ask. And typically I like to sell market trade. So typically you're guaranteed the bid price. So let's see how much I would probably get. So I'll set this to sell to open. I'm doing it as one contract, and I'll change this to market order. Now for Schwab, and I don't think Robinhood works this way, but I don't know about TD Ameritrade, but I'm guaranteed this $85 pretty much. And actually, they've got a guarantee that they'll do better if they can. And probably half my trades, maybe more than half, I'll do a little bit better. So this is saying I would get 85 on one contract. So for a cash secured put, I'd end up using 3,000 in cash to earn $85, which isn't bad. Again, this is an inexpensive stock. But say I wanted to do a vertical credit spread, what I can do is I can come under strategy and I can say I want to do a vertical put, and I want to change this back to 30 since this is the inner arm or the position I'm shorting. So you can see that 85 shows up, and this is the outer arm, and I want this to be 20. It looked like 20 was $18. I noticed that pretty much everything else, this was the only area I could find. This $18 at 20 was the only option I could purchase inexpensively. To me, $18 isn't too bad, but if I do two contracts, that's $36. So here I would earn $67 on the difference between 20 and 30. So I would need about 1,000 in cash. And how I did that is you take the 30, so that would be 3,000 minus 2,000, which would make it where I need about $1,000 in cash to cover this. So to earn 67 on 1,000 is pretty good. It's definitely better than 85 on 3,000. And why it works that way is if the stock went down below 20 with this outer arm, I could put it to somebody, meaning the worst case scenario, if it goes down to 18, I could put it to someone at 20, and that's why it reduces the risk. So if the market drops like it did 2 years ago and it goes down to 14, well, I can still put it to whoever bought this contract or sold this contract. I could put it to them at 20, and that's why it's called a vertical credit spread, and they're both the same days. So it wouldn't be vertical if the dates were different. If another option that I could do is I could set this way into the future and buy it, and then sell more options against it. That's something I may look at too, going down, in the future. But for now, I'm going to stick to this. $67 for a trade is pretty good. And again, I can probably do a little bit better. So I am going to go for the vertical credit spread. And so this is sell to open. So I'm opening this position. I would earn $85. And then I'm buying the $20 put for 18 cents, and the net would be 67 cents. And again, I like to do a market order, and I'm actually going to do two, and it may end up, yeah, I have to set this again as a market order. So it shows I'm going to make $136 on this trade, and I'm going to use $2,000 of my margin, or that cash. When I say margin, I'm meaning this will go down by 2,000, a little less than 2,000. It'll take into account this $136. So it'd be about what, 28, I guess. Yeah, 2,800, 2740 or something like that. Actually 2840, I guess. Not sure I'm doing my math real good or real well. So, and then all we really need to do is I can click review order, and it'll let me, it's just confirming. Now I do have some fees, so it's going to be pretty close to $130. So everything looks good. They're saying, we're ready to launch, and then I'll click place order, and it looks like it went through, and I can look at order status, and here it is. So I got 95, which is better than the 85, and actually I bought it for cheaper for 9, so the net would be the difference in those two, so it would be about 86. So I really made closer to $170 for this trade. So again, this is how it works with Schwab. I pretty much know Robinhood doesn't work this way. TD Ameritrade does. I don't know about some of the other traders like Interactive Brokers and Webull and some of those, but this is one of the things that Schwab does that I think is wonderful. So I've just made close to $160. I've spent the time you've seen here. I think I did a little bit of research that determined I wanted to own Academy Sports. So that is a vertical put credit spread. I could have done it as a cash secured put, and I would have used a little bit more of my cash that I have in that account or the margin that I have in that account. But in these instances, I can look at doing another trade. If the market drops a little bit more, these values may go up. And so I hope you enjoyed this. If you have any questions, please leave a comment below. And please return. I'm planning to do more videos going forward with how to actually sell options on Schwab. I really like Schwab. It's been a really good brokerage, and I've been working with them for over 30 years. So hope you have a wonderful day. Thanks for joining me.